The rejection notice was sitting in his inbox, glowing with the sterile, mocking blue of a standard banking interface. It wasn't a foreclosure notice. It wasn't a massive lawsuit. It was a $25 payment, a simple, automated monthly subscription fee, that had been unceremoniously bounced back with the cold, automated tag, Insufficient Funds. For most, $25 is the price of a takeout meal or a streaming subscription. But for Elias, it was the final, agonizing crack in a foundation that had been crumbling for months. He stared at the screen, his cursor hovering over the blinking error message. How could his account be empty? He had been meticulous. He tracked every cent, every transaction, every recurring payment. He lived in a world of spreadsheets and rigid financial discipline. Yet, the bank's algorithm, an emotionless machine of ones and zeros, had decided that he was broke. He wasn't just broke, he was officially insolvent, reduced to a digital pariah by a computer program that didn't know his name, his history, or the promises made to his ancestors. This wasn't just about $25. It was about the realization that the system he trusted to secure his life was, in fact, operating on a different reality than his own. While he saw numbers on a screen, the bank saw entries in a ledger that no longer corresponded to the physical world. It was a glitch in the matrix of his personal finances, a small, jagged hole through which he could see the rotting floorboards of the banking institution itself. He didn't know it yet, but that bounced payment was the first domino in a chain reaction that would lead him down a rabbit hole of hidden trusts, century-old legal loopholes, and a financial mystery that reached back to the very foundation of the modern monetary system. He left the bank's website and went to his filing cabinet, the old, wooden one he'd inherited from his grandfather. It smelled of cedar and dust. He began digging through yellowing envelopes and brittle carbon copies, looking for the one document he had been told to open only if the system failed. He had always thought his grandfather was being melodramatic, the product of a generation that distrusted banks because they had seen them fail in the Great Depression. But as he pulled out the document, a heavy, cream-colored piece of vellum sealed with wax, the air in his office seemed to grow thin. The seal wasn't just an ornament, it was a stamp from a trust department of a bank that hadn't existed in over 50 years. He realized then that the $25 rejection wasn't a mistake. It was a signal. It was the system purging his account because it didn't recognize the provenance of the money that was supposed to be there. He wasn't playing by the same rules as everyone else, and for the first time in his life, he was about to find out exactly why. The story of the forgotten trust began not with wealth, but with a desperate attempt to protect it from the very institutions that were now denying him his own capital. He didn't know the full extent of the deception, nor did he realize how deep the rabbit hole went. He was standing on the precipice of a discovery that would pit him against the most powerful financial forces in the world. He started to piece together the timeline, the origins of the trust, the secret agreements made behind closed doors in the 1920s, and the way those agreements had been buried under layers of corporate restructuring and bureaucratic red tape. The $25 wasn't just a missed payment, it was the start of a war. And as he stared at the document, he understood that to get his money, he would have to expose a truth that the banks had spent decades trying to keep hidden from the public. Elias's descent into the rabbit hole began with the realization that the bank's rejection wasn't a human error, but a calculated purge by the institution's automated risk management software. He spent the next 48 hours ignoring his job, his emails, and his basic physical needs, obsessively tracing the origins of that heavy, wax-sealed document. The trust wasn't a bank account in the conventional sense, it was a legacy of an era when wealth was measured in physical assets, not ephemeral digital entries. His grandfather, a man who had survived the banking panics of the early 20th century, had been part of a quiet, desperate movement to preserve personal autonomy against an increasingly centralized financial machine. As Elias cross-referenced the names on the document with digitized archives of bank mergers, he realized the institution that now held his account was actually a third-generation successor to the original vault. The bank hadn't just changed its name, it had systematically offloaded the burdensome liabilities of the past while absorbing the assets of the future. He discovered that thousands of accounts, some dating back to the aftermath of the gold standard's abandonment, had been shifted into a dormant category, a purgatory where the money still technically existed on paper but was legally inaccessible to the rightful heirs. The bank used these dormant funds to pad their own liquidity ratios, effectively using the money of their forgotten depositors as collateral for their own high-stakes derivative bets. He spent hours on the phone, moving through the labyrinth of corporate customer service, being passed from representative to representative. Each person he spoke to followed the same script. They were helpful, polite, and completely incapable of understanding his request. When he mentioned the trust, their voices would tighten. It was a phantom, a ghost in the machine that no longer appeared in their current software. They didn't see a trust, they saw a clerical error, a legacy file that had been corrupted and subsequently deleted during a data migration decades ago. To them, the money had never existed, and his insistence was not just an annoyance, it was a liability. The contrast between his grandfather's meticulous record-keeping and the bank's fluid, shifting reality was jarring. While the bank claimed that their systems were perfect and their databases infallible, Elias was uncovering a history of deliberate obfuscation. He found evidence of restructuring events where specific legacy trusts were subdivided and dissolved into the bank's general operating capital. It was a slow-motion heist conducted through legal filings and quiet board meetings. The more he dug, the more he understood that the $25 rejection was the system's way of saying, "You are no longer in our database, and therefore, you do not exist." His investigation led him to a retired clerk who had worked in the bank's trust department during the late 80s. Meeting in a quiet, dimly lit diner, the man was hesitant, his eyes constantly scanning the room. He explained that there were two sets of books in the banking world, the one presented to regulators and the public, and the shadow ledger where these legacy assets were tracked. The shadow ledger was kept offline, in a physical vault, specifically because it was a hot potato that could never be exposed to the digital systems. The $25 he tried to pay was likely the first time his account had interacted with the main, automated system in decades, triggering an immediate red flag that stripped his status and tried to close the link permanently. Elias was beginning to see the scale of the operation. This wasn't just about his money, it was about the thousands of families whose inheritances had been cannibalized to keep the institution's balance sheet looking robust during market downturns. He had the names of the individuals responsible for the last major cleanup of the trust department, a list of executives who had since moved on to prominent positions in government and regulatory bodies. The story was becoming more than a personal grievance, it was becoming a roadmap to systemic rot. He realized he was no longer looking for his own inheritance, he was looking for the evidence that could pull the thread on a multi-billion-dollar deception. He had barely scratched the surface, yet he could already feel the pressure mounting. The bank's security algorithms, which had been silent for decades, were suddenly updating their flags, and he felt like he was being tracked, not by people, but by the relentless, cold logic of the system he was trying to dismantle. The retired clerk's revelation about the shadow ledger was the catalyst Elias needed. He understood now that his battle wasn't against a faceless customer service agent, but against a structural architectural flaw in modern finance. The bank didn't just manage his money, they managed a narrative about his money. By maintaining a shadow ledger, they protected their liquidity while maintaining the illusion that the institution was perfectly capitalized. Elias spent the next several days mapping the flow of these dormant assets. He discovered that the trust wasn't a singular, isolated event, it was a node in a much larger network of shell trusts, each designed to house assets that the bank didn't want to account for during regular audits. He began using his background in data analysis to cross-reference the bank's public filings, their 10K reports, their quarterly earnings calls, and their regulatory disclosures, with the erratic, fragmented data he had retrieved from his grandfather's records. The discrepancy was staggering. The bank claimed that the physical assets backing these legacy trusts had been liquidated to cover administrative costs. Yet the internal memos he found in the archives told a different story. The assets, gold, physical deeds, and rare commodity contracts, had been moved into an off-balance sheet vehicle. They weren't liquidated, they were being leveraged. This brought him to the heart of the paper versus physical discrepancy. He realized that the bank was doing exactly what his grandfather had feared, they were selling paper representations of his physical wealth while the actual asset sat in a vault, providing the collateral for high-frequency trading and speculative bets. The bank was effectively printing money against his family's physical inheritance, creating an infinite supply of paper promises that had no underlying tangible backing. The moment Elias had tried to verify his $25 payment against the active system, he had accidentally triggered an alert because his account, in the bank's primary database, was marked as physical asset occupant. The system didn't know how to treat him because he was, quite literally, a ghost in their ledger. Elias dove deeper into the mechanics of COMEX and the broader precious metals market, looking for any sign that the bank was feeling the heat. He found it. In the months leading up to his rejected payment, the bank had been rapidly adjusting their registered versus eligible inventory ratios. They were bleeding physical supply to meet the delivery demands of other, much larger institutional investors, leaving the smaller, legacy trusts like his own as the only remaining, easily accessible sources of physical collateral. He wasn't just a victim of a clerical error, he was a potential casualty of a massive, systemic liquidity crunch. The bank needed his trust's assets to keep the charade of their solvency alive for another fiscal quarter. The tension was palpable. Every time he logged into his research portal, he felt the weight of the bank's digital perimeter. He wasn't just an individual. He was an anomaly that threatened the stability of their current derivative structure. He found evidence of stress tests that the bank had conducted internally, simulations that predicted exactly what would happen if a legacy depositor ever successfully linked their physical claim to the electronic ledger. The result of those simulations was always the same, a run on the bank's physical reserves that would force a public disclosure of their hidden leverage. He knew he couldn't walk into the branch and demand his money. He needed to be surgical. He started documenting the movement of the trust's original assets, tracing their path through various subsidiaries and shell companies. He found a trail of signatures, authorization codes, and internal memos that implicated the current C-suite in the ongoing management of these zombie assets. The level of complexity was designed to be impenetrable, a maze of legal and technical jargon meant to discourage anyone from digging deep enough to find the truth. But Elias didn't need to navigate the maze, he just needed to find the one entry point where the digital and physical worlds connected. He found it in an obscure, legacy clearinghouse system that was still running on mainframe code from the 1970s. It was the bridge between the shadow ledger and the public ledger, the only place where the bank had to account for the physical reality of the assets. He had found the kill switch. Elias stared at the terminal output, his heart hammering against his ribs like a trapped bird. The archaic mainframe code, a relic of a bygone era, was scrolling before him, revealing the truth he had spent weeks hunting. The forgotten trust wasn't lost, it was being actively leveraged as a cornerstone of the bank's derivative liquidity. Every time the market for precious metals tightened, the bank tapped into these legacy vaults, essentially borrowing the underlying assets to stave off margin calls in their electronic trading desks. This was why his $25 payment had failed. The system had flagged his account as active/leveraged, and the automated check had realized there was a conflict between the account's claim and the bank's actual physical inventory. The revelation hit him with the force of a physical blow. He wasn't just fighting a bank, he was witnessing the fundamental rot of the modern financial system. The paper supply of silver and gold that the bank dealt in was a house of cards, built entirely on the backs of thousands of legacy accounts like his grandfather's. If these depositors were to suddenly awaken, to connect their physical claims back to the ledger, the bank's derivative empire would evaporate overnight. He felt a cold chill run down his spine. The forgotten status of his trust was a design feature, not a bug. By keeping the legacy files in this digital limbo, the bank could effectively utilize the assets indefinitely, provided the true owners never tried to claim them. It was a perfect, self-sustaining loop of exploitation. But now, he held the keys to the bridge. He saw the exact transfer dates, the ledger IDs, and the internal codes used to move his grandfather's physical wealth into the bank's general, unallocated/registered, pool. He realized he could not simply walk into a branch and shout about what he had found. The system was designed to handle such disturbances, with legal suppression and institutional gaslighting. He needed a different approach. He had to create a digital alarm that would force the bank's own compliance software to acknowledge the legitimacy of the trust. If he could create a ping, a specific request that forced a reconciliation between the shadow ledger and the public ledger, the bank's own automated governance would be forced to reconcile the discrepancy. But there was a catch. Executing this reconciliation would notify the bank's internal security team immediately. He would have, at most, a few minutes before they traced the source of the inquiry and locked down the account for good, potentially destroying the digital evidence he had painstakingly gathered. This was the point of no return. He had to choose, walk away and live in the quiet misery of the status quo, or press the button and risk everything. He thought of his grandfather, the man who had been so prescient about the fragility of the system. He hadn't just left him an inheritance, he had left him a weapon. The weight of the situation felt immense. He wasn't just a grandson looking for his money, he was a whistleblower standing at the edge of a systemic collapse. He looked at the cursor, blinking in the dark, and realized that his $25 rejection was the only thing that had saved him. It was the only reason he had bothered to look. He realized that millions of others were likely in the same situation, their legacies silently siphoned off to feed a monster that they didn't even know existed. He decided that the truth was worth more than the $25. He prepared the sequence, checked the address, and steeled himself for the fallout. The silence in his apartment was deafening, amplified by the realization that he was about to change the trajectory of his life forever. He took a deep breath, his finger hovering over the enter key, knowing that whatever happened next, the bank would never be able to hide the truth again. Elias pressed the enter key. The screen flickered, a series of cascading error codes flooded the monitor, and then, silence. For a heart-stopping moment, he thought he had crashed his own connection. Then, the mainframe responded. The bridge, the long-dormant link between his grandfather's physical trust and the bank's electronic ledger, suddenly pulsed with activity. He wasn't just looking at his account, he was watching the bank's internal stress test fail in real time. The system, unable to reconcile the sudden re-emergence of a verified physical claim against its hollowed-out derivative balance, triggered an automatic audit freeze across the entire subsidiary. The fallout was instantaneous. His inbox began to flood with automated notifications, not from the retail customer service department, but from the legal and compliance offices. He had done it. He had forced the machine to acknowledge the truth. The bank's algorithm, programmed to prioritize liquidity, was now desperately trying to find an equivalent physical asset to offset the claim. It couldn't. The vault was empty, and the paper promises were worth less than the ink they were printed on. By exposing the whole, he had turned a forgotten trust into a public liability that the bank couldn't ignore, delete, or hide. In the weeks that followed, the story didn't stay hidden in a digital folder. Elias, armed with the undeniable audit trail of the shadow ledger, navigated the legal system with a precision that the bank couldn't counter. They tried to settle, they tried to intimidate, and they even tried to claim the account had been orphaned by international regulation, but the evidence was too systemic to brush away. The $25 payment that had started as a rejection notice ended as the cornerstone of a precedent-setting legal victory. He had not only reclaimed his grandfather's legacy but had effectively forced a public disclosure of how deep the paper-to-physical discrepancy actually ran. The bank was forced to restructure, a polite corporate term for liquidating their derivative bets to pay back the actual physical claims they had been borrowing against for decades. Elias's victory was a quiet one, but it sent shockwaves through the institutional halls of the sector. It proved that the system was only as strong as its ability to keep the truth in the dark. The shadow poll. I want to hear from you. Have you ever checked your own long-dormant family accounts, or felt that the numbers in your bank app just don't match the reality of the economy? Drop a comment with the word ledger if you think the banks are hiding more than just your money. Community experiment. If this video hits 50,000 likes, I'm going to do a deep dive into the specific SEC filings that prove how the COMEX registered inventory has been manipulated over the last decade. Let's force the conversation into the light. If you found this story of resilience and truth-seeking as gripping as I did, hit that subscribe button right now. We are going to continue peeling back the layers of these financial institutions every single week, exposing the mechanics that they pray you never understand. Don't just let the algorithm decide your reality. Stay informed, stay skeptical, and stay tuned for the next investigation. Click the notification bell so you don't miss the next report, because once the truth is out, there's no turning back. Your support is the only thing that keeps this channel independent and capable of digging into stories the big players want to keep buried. Subscribe, share this with someone who still trusts the official numbers, and let's keep the pressure on.